Hello and welcome to Deep Dive on NewsX World. I'm Kriti Mehta. Now today we're breaking down a decision that will affect everything from your rent to your loan payment to the global markets. The US Federal Reserve has cut interest rates for the third time this year, but this time the move has exposed deep divisions inside America's most powerful economic institution. And it's happening at a moment when prices are rising, the job market is cooling, and the president is pushing hard for even more cuts. So what does this really mean for everyday Americans? And who exactly is the economy working for? Let's dive in. US Fed Chief Jerome Powell has come up with the new cuts. The Fed has lowered its key lending rate by 0.25 percentage points to a range of 3.5% to 3.75%, the lowest in 3 years. The decision wasn't unanimous. 3 Fed officials broke ranks, a sign of a rising uncertainty about where the economy is headed. And that economy is flashing warning signs. The US job market is losing momentum. The employment rate has ticked up to 4.4% and companies are slowing their hiring. At the same time, prices remain elevated. Inflation is at 3% above the Fed's target. And for families, the pain is most visible in daily essentials. Grocery prices are up 2.7% over the past year. Electricity and natural gas prices have spiked. Vehicle insurance has seen double-digit increases. Housing costs remain one of the biggest financial burdens. American households are feeling the squeeze even as wage growth struggles to keep up. So what is this rate cut supposed to achieve? The Fed hopes that lower borrowing costs will stimulate business investments, support hiring, and avoid a deeper economic slowdown. But there's a risk. Cheaper credit can also fuel more inflation, which Americans are already struggling with. And that's why the Fed is so divided. Here's what the Fed Chair Jerome Powell has said. Listen in.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate.
But one person wants deeper, faster cuts. The President of the United States. President Donald Trump criticized the move, saying the cut should have been at least doubled. Listen in.
The head of the Federal Reserve is a stiff, and you fight that. It's amazing. We fight that, and yet interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small a number that could have been doubled, at least doubled. And that's the other thing. I think the rates for the United States are always the lowest in the world, because without us, there is no world.
So why is he pushing so hard? Analysts point to 3 key reasons. Political timing. Lower rates can boost growth in key sectors before elections. Market performance. Trump often measures his success through stock market levels. And short-term economic stimulus. Cheap money can create the appearance of a stronger economy. Now, this puts him directly at odds with Powell's cautious approach. But there's another question looming over all of this. Who actually benefits when rates come down? Here's where we talk about a less visible layer of the American economy. How the rich hoard wealth and why rate cuts often help the top more than the middle. In the US, the rich don't hoard cash in vaults. They build and preserve wealth through investments and a tax system filled with advantages. Let's break it down. Tax avoidance and loopholes. Complex structures minimize taxes. Low capital gains. Stocks and real estate taxed less than wages. Borrowing against assets. avoid selling and paying taxes. Trusts and estates pass on wealth largely tax-free. Real estate depreciation cuts taxable income. Investments, stocks, bonds, private equity grow faster than wages. Wealth defensive industry, lawyers and accountants protect fortunes. Political influence, lobbying keeps the system favorable. And in this context, hoarding is metaphorical, concentrating wealth in ways that limit its flow back into the broader economy. Analysts warn this intensifies inequality and poses social risks. Now, when the Fed cuts rates, asset owners benefit first, not wage earners. Stocks climb, real estate gains, and cheaper credit favors those who already have wealth. A Fed trying to avoid a slowdown. A president pushing for bigger cuts, rising everyday costs. Now, joining us in this discussion is Gerald Alfil, who's an economist and joins us live from Dubai. Thank you, Gerard, for speaking to us here at NewsX World. We appreciate you taking time out for us.
Thank you. Good afternoon.
Good afternoon to you. Gerard, I'll start with my first question to you. What do you think, firstly, are the key takeaways from Powell's presser?
Well, it shows that there might be, they expect a slowdown in the economy in the coming years. You mentioned stock market performances. In fact, Dow Jones Index and NASDAQ have been performing very well in the last 3, even 5 years. And this heat cannot continue. There was definitely pressure from President Trump, and it looks like the air gets thinner and thinner. I would like to quote Mr. Sergio Ermotti, the group CEO of UBS Bank, one of the biggest banks in the world, the Swiss bank. He was in the UAE this week at the Abu Dhabi Finance Week, where I also covered the event for FinNews, Swisswire FinNews. And Sergio Ermotti, the CEO of UBS Bank, said, quote, the investors might lose patience with some AI stocks and with the whole AI development, which is very bullish, extremely bullish. And he also recommended for 2026, and now this is important, he said, leaves a good portion of cash on the side for 2026. He's a top banker of UBS Bank, of the biggest bank, one of the biggest banks in the world. Does he know something more than us? Keeping cash on the side means the air gets thinner and thinner, and we take away that also the Fed sees sooner or later here a cool down and asset inflation. We know there's not only inflation for goods which you buy in the grocery, but there's also asset inflation. And asset inflation has been rising very much. That cannot go forever, and also President Trump, as a businessman, knows that very well.
All right, Gerard, let's also talk about how will the latest Fed cuts affect the lives of everyday Americans and their finances?
Well, lower interest rates, as you said, means a lower price for credits. The interest rate is the price of the credit. The price of money is that if you have money that you don't have the goods which you can buy for them. So that means your credit card costs will be lower. Homeowners can buy homes for lower mortgages, for lower rates and loans. And of course, the lower dollar means you can import less, or you have to pay more for imports, because a lower dollar means a stronger Swiss franc, a stronger euro, a stronger yen, and so on. That means importing goods will be more expensive, but here's the thing, President Trump prefers America first, buy American products, buy American services, and I think this also is in line with his policy. If you buy domestic goods which have been domestically produced, of course they are then also cheaper in relation to credit.
All right, and how are these cuts going to affect the global economy and the global markets?
Global markets, as said, the foreign exchange rates are now in favor of the other currencies, the non-dollar currencies such as euro, yen, Swiss franc. Swiss franc very bullish now, and that means it's cheaper to travel to the US if the currency stays so strong. You have good purchasing power if you go to the US next year to the FIFA World Cup, for example. On the other hand, this means that also there's an expectation of a cooling down of the world economy, which could be a sign of holding investments, which could indicate that people will hold investments back. So if you are more cautious, definitely you will invest less. You might not run into the stock market with that euphoria as we have seen this year or the last year. And the global economy also, I think China and Europe will emerge stronger from this development because they have adapted to the tariff dispute this year, but also to the lower dollar.
And I'm going to ask you a very basic question now. Are rate cuts mainly benefiting the wealthy rather than the wage earners?
Well, the happy few, of course, they also will benefit. Do they benefit more? I'm not sure because they're also heavily invested in AI and in the stock market and also in the debt market. That market, interest rates are lower, is not a good sign because if you buy into bonds, you will earn less. But it's hard to tell. Again, going back to the quote by the UBS CEO, Mr. Sergio Armotti, he recommends to have a good portion of cash in the next 12 to 24 months. That means the well-to-do have to be careful and cautious. We had seen knockout effects in 2008 and 9 during the last financial crisis, but also during the internet bubble when it got burst in March 2000. So it's hard to tell, but you can diversify, of course, your portfolio better if you have more capital on your bank account and also diversified already in gold, property, agriculture, debt markets, cryptocurrencies. This is something the normal wage owner cannot do.
All right. Gerard, would you say that Trump's pressure on Powell is influencing the Fed policy decisions?
It's hard to tell. I mean, definitely there is pressure. There is verbal pressure. There is gesture economics behind this. You mentioned that the vote was not unanimous, which is, I think, a good sign because it shows that the checks and balances work. The Constitution of the United States does not require unanimous votes by the Fed, but of course there can be disputes. The disputes can be public. The disagreements can be public, must be public in a democracy. Also shows that the U.S. is not a monarchy as some people state. Definitely there is pressure. It will continue, and President Trump will continue his policy of America first.
All right, and my final question to you, as an economist, what do you think? What should the Fed prioritize, jobs, inflation, or economic stability?
Per the Constitution, the Fed's mission is to keep the economy running and not so much the inflation like the European Central Bank has to focus on. So keeping interest rates low means, yes, we anticipate that the heat goes out of the markets, of the asset inflation, stock markets, also cryptocurrencies. But the Fed must focus on the consumer. The consumer is the critical factor in the United States and the biggest economy of the world. And that's the mission that will remain. The mission, inflation might rise because of lower interest rates, but keep the economy running. That's the Fed's mission.
All right, Gerard, thank you for that discussion. Very meaningful insights that we've gotten from you. And viewers, with that, it's a wrap on this episode of a Deep Dive. But stay tuned for more.